Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is American Tower Corporation. This is a REIT with ticker AMT. Over the next 5 minutes, I will discuss both the valuation and what I think of the quality of this company. Let's dive on in. So, American Tower Corporation, it's a REIT, and that means that it's going to be paying out a lot of its money that it receives in dividends. REITs are required to pay out 90% of their income as dividends each and every year. And so it's one of the largest global REITs, leading independent owner, operator, and developer of multi-tenant communications real estate. So this is likely real estate towers. So you have about 181,000 communication sites. So these are basically communications towers used in probably cell phone towers. And various things like that for telecommunications. So you have a beta of 0.44. This is significant because it's substantially lower than the average S&P 500 company, and that stability typically means that there's lower volatility, obviously in the stock price, but probably also lower volatility in the business. Now, if we look back, they've had losses, but they've had no losses since 2006. So it looks like a startup period here almost in 2001, 2002, 3, 4, and 5. But since 2006, they've been profitable. And so let's see their return on invested capital has grown steadily over that time, it looks like. So in 2008, we're at 4%, 3%, 4%, 4%, 5%, 4%, 4%, 3%, 3, 4, 4, 5, 4. So pretty stably in the range of 3 to 5% return on invested capital since they turned profitable in 2008. So that's decent, but you're going to have a lot of leverage in order to ramp that return on invested capital up to return on equity. Now, that is what I see when I look at this 10-year median return. So they do have a return on equity of 18%. So even though return on invested capital is lower than I'd like to see double digits, return on equity is above my target of 15%. So I'm pretty excited about that because it does look like it's pretty stably profitable over time. And so that could be really attractive. Now, others have also noticed that this is an attractive company. You have the PE at 41. This is incredibly high. Likewise with the price to sales of 11.5. This is already a price way too high for me to pay. I would never pay more than a price to sales of 10. And so at a price to sales of 11.5, this is simply too high of a price to justify buying the stock at. However, you can clearly see why. So they have strong 10-year CAGR. Your revenue is growing at 15% a year. EPS growing at 15% a year. Now, there's a little bit of a concern because assets is growing faster than revenue. And so there's some concern that over time you're going to have worse and worse returns. But clearly they're making that work. Although you have to have a lot of debt built up on this balance sheet in order to justify this jump from 4.4% to 18%. So there's a lot of leverage inherent in this balance sheet here. But when we look at these EPSs, we can see kind of growing from $1 at the beginning of the decade up to somewhere in the range of $4 by the end of the decade. So 4xing your earnings in a period of 10 years, which again is about that right at 15% EPS, is very strong. So you really like to see that. And you can see that they've had this return on equity in the double digits the whole decade. So they're doing quite well keeping that up throughout that time period. So let's see what else we can see. Income statement, you can see that operating profit has been profitable every year for the last decade as well. And the net income's been doing quite well. However, you can also see that there's some dilution going on. You started the decade with about 400 million shares outstanding, and you're ending at 444% or 440 shares outstanding. Now, so you've basically increased shares outstanding by about 10%. But you've 3 to 4 extra EPS, so they're clearly doing well with, despite issuing shares, it's not slowing down their growth in EPS. So balance sheet, we can see they're going to be taking on a lot of debt here. So you can see they have $5.5 billion in debt to begin the decade and $28 billion in debt to end the decade, and that money's going into a lot of this property, plant, and equipment. So PP&E has increased by $17 billion. And the debt is increased by $23 billion. So you've increased the debt more than PP&E, but some of that has gone into goodwill, it looks like. So you can see that money's kind of building up there. They don't hold much cash, so this is, again, very leveraged balance sheet. Cash flow. It's not been a constant issuing of cash. Let's see what if they pay out. They don't list share-based compensation. Let's see, cash flow statement. that they do here. So you do have pretty steady stock-based compensation each and every year, so that's adding to that slow and steady dilution. But they also have some buybacks over time at various points, but also issuing. So they're doing some acquisitions, it looks like, in a few periods, and so that's kind of causing the issue there. But you can see that steady and growing dividend over time as they pay out that 90% of income. So pretty well. This looks like a really strong business. My only objection really is the price. So I like what I see here. They could use a little bit more stability in the gross margin, but they might be getting into different real estate. You can see it kind of jumped down in 2016, and that aligns around where that acquisition was. But you can see the dividend growth, 22%, 27, 29, 19. So dividends are growing at almost 20% a year per share. So that's very strong. You like to see that. So I'm really impressed with this business. This business looks attractive. I don't really know how consistent they can be going forward. In order to turn a 4 to 5% return on invested capital into an 18% return on equity, you're really busting the leverage, which again, that's not abnormal in real estate. So they've been making some good, strong decisions here. You can see that $30 billion in debt against, $100 billion in market cap. So it seems pretty well managed. I like the stock here in terms of the business quality, but I think the price is just too high. It's really hard to justify paying a 40 PE for anything. I'd like to pay a PE under 20, so that means you need to cut the stock price in half, maybe $135 a share, even though you have this really high justifiable revenue and EPS growth. So this is what you want. You want to see high revenue and EPS growth. They're doing it faster than they're issuing shares, so they're certainly justified there, but the price is simply too high. So that's my case here. I like this. American Tire probably goes on my watch list, but it's just too high of a price. I want to cut it down, and I want to buy at a PE of 15, but for a company like this, maybe you can justify a PE of 20, but either way, you're looking at a price below $115 a share. So thank you for listening, and until next time, stop paying fees, start building wealth. Hit that like button and subscribe for more great videos.